This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
G'day, how you going? Phil Tarrant, host of the Smart Property Investment Show. Hope you're well. Summer series. We're in summer, December through February.
Exciting times.
It is. That's a technical term for it. Grace Ormsby, who's joining me in the studio today, our editor of real estate. We're at work while everyone else is not at work, so fear not. The good ship Smart Property Investment is still here. We're still doing what we're doing over summer period to make sure you get your fill of Smart Property Investment Show, and there's a lot of fill in a Smart Property Investment Show.
I mean, we won't do any product placement either, but there's some
product placements.
Some beverages being consumed.
We are, because it is summertime, and it's our rights while we're on leave. We're spending our time on our leave to have a yarn to our property investor friends, colleagues, associates. It's been a good year, and it's been an interesting year, and we'll break down a little bit in this podcast what 2023 has in store. And you find this time of the year everyone talks about what's happening next year. I'm happy to report. Can't say much about it, but I can tell you this. Something very good and very big and really interesting is coming early 2023. And guess what? You'll be the first to know when I'm ready to start talking about it. But watch this space. But hopefully it'll give you some sense for how you can effectively invest in property over 2023. And I'm going to give you some stuff that you can't find anywhere else. It's the good oil. So fear not, it'll be available, and I reckon you'll be pretty interested. It's sort of connected in with today, but we're at that time of the year when everyone talks about what's going on in property. What's 2023 going to bring? And we're recording this after the December rate announcement. Newsflash, no rate rise next month in January. I can absolutely guarantee that because the Reserve Bank doesn't meet Grace. But,
what a gift.
What a gift. But we know that when the Reserve Bank gets together in February, it's going to have two months of data. So hopefully they can make an informed decision of what they're going to do with interest rates. We've been pretty good picking it. I picked sort of 25 basis points in December. The market is pricing in an interest rate around 3.6%, I think. So there's still another 50 basis points in it. Some people are saying that might be enough. 2 months of data for the Reserve Bank of Australia. Maybe we are at the top of the interest rate cycle. Who knows? Maybe there's a little bit to go, but I'm erring on conservative. I'd be pricing in another 50 basis points and probably a little bit more just to be on the safe side in your ability to service a mortgage. But I think it's going to be a softer landing in relation to interest rates to where initially some pundits had it accelerating way up over 4% cash rate. So good news for investors. Gives you a bit of a sense into the health of the economy, where it's heading, where the direction is. You know, we still have some of those supply constraints which are shaking things up. Migration's coming in, wars in Europe. I don't want to go over all that sort of stuff. But you're going to get a lot of what's going to happen in property in 2023. So, Grace, we're going to participate in this as well.
We are. We might as well. I mean, following on from your point too, Phil, I think it's quite interesting that recently Governor Lowe of the RBA, the head man over there, he came out and said, you know, we're sorry for anyone who did make decisions based on the fact that we wouldn't be lifting rates until late 2023, 2024. So the fact that they've gone again over the Christmas period when a lot of people thought that they probably should cool it, let people do some spending over Christmas time, I think means that we are sort of in for shorter, sharper pain than we would be otherwise. So I think that's actually quite a good thing.
I think it's a great thing.
We've gone up again.
And I'm not an economic person. I'm but a humble journalist. No, but my view, I would rather they make the mistake of going too hard too early and then relaxing a little bit. That's a beer bottle cap there bouncing on the thing, rather than going too slow and exacerbating some of the impacts. To be fair to the Governor Lowe of the Reserve Bank, when he made his statements around the interest rates not shifting until sort of 2024, that was prior to Russia's invasion of Ukraine and everything that's manifested as a result of that. So you've got to give the guy a bit of a break, a bit of a shock to Australian borrowers and people sort of interconnected with the economy. But it comes back to the point, if you're investing in property, and this is a podcast for property investors, Grace, if you're investing in property, you've got to invest on your own terms around those things that you can control. There's always going to be stuff that you can't control. And whether or not Vladimir Putin's got a beef with the Donbass region in Ukraine and decides to invade, guess what? you can't do anything about that. So you got to make sure, irrespective of what's happening.
It'd be nice if someone
It'd be nice to. People are trying to.
It'd be really nice if someone did, have that influence, but
maybe we can fix it up. Maybe we can do a letter to Moscow. Hey, come on, we want to keep our interest rates under control here. So that's what's going to happen. But our good friends, largely your friends, and you can give a bit of a shout out over at Domain. I've got to be upfront, and because I also talk a little bit about aviation. I'm a Qantas man rather than a Virgin man. I'm a Qantas frequent flyer, and I get all the perks and benefits from it. In property platforms, I'm a realestate.com guy. I'm sorry to say. But we're a broad church here at Smart Property Investment. That's just my own preference and behaviours, right?
Yeah.
So this is from our friends over at Domain.
And they've come out with a really good and timely end-of-year report. And really that's what it comes down to, the quality of the data that's contained within this. And there's just some really interesting stuff in here, Phil, about what they're expecting for 2023. And I do find it funny that the report is literally prefaced with a roller coaster in property cycles, and then the year that transitioned into a downturn from a once-in-a-generation property boom.
There's your headline. You love headlines.
Yeah, it's a good one, a roller coaster in property cycles. It has been an absolute roller coaster this year when you do think back to the property price increases we were seeing, even from January, before the market had even picked up over Christmas. It never slowed down, which is entirely unusual for this industry.
Yeah, and we're actually talking about this before we're allowed to talk about it. This is, I don't want to bore everyone with it. We get embargo stuff. So we get stuff before everyone else and pretty much says, here it is, you can prepare, but don't talk about this until the embargo's over. So, this is okay because we're slightly pre-recording this, so we're going to be inside of the realms. And then to our friends over at Domain, I'm happy to be convinced on as Domain either. My personal preference, and I'll just, I've got no allegiance to either of the different property platforms. I've just habitually used realestate.com.au, but that doesn't say that Domain doesn't do good stuff either. And friends over at Domain, if you want to come and yarn to me and tell me why you guys are great, happy to have a chat with you. But Grace,
and let's be real, you've definitely flown Virgin before.
You know what? I flew Virgin. I had to fly Virgin. I had to fly Virgin. Last week I had to go to Canberra to do some stuff, and I couldn't fly down on because it was the last week of Parliament, and I couldn't get on a Qantas flight in the right time that I needed to get there. I didn't want to spend a whole day waiting for a meeting, and so I flew Virgin.
See,
I flew Virgin.
You're agnostic.
I am, and the guys and girls over at Virgin, they sort of got me into their new Beyond Lounge, which is awfully fancy. I highly encourage anyone to check it out. Well, it's one of those things you don't know about it. You don't know about it. You don't know about it type of thing. But it was really, really good. Anyway, they do truffle fries.
Wow.
They do truffle fries. But anyway, which I tried, I just sort of had a little nibble of them. I didn't eat the whole bowl.
Sure.
It's coming in the summer and stuff, and Beachbody and all that sort of stuff. But it says here, Grace,
series.
it is the summer series, a roller coaster. It says a roller coaster in property cycles. Let's get stuck into it, Grace, and give some insights from this report from Domain. And I'm going to go through the press release, which is pretty much an executive summary. But hold on, we're going to go to a break beforehand. I'm getting a wind up. Stay with us. Back in a moment. Welcome back. Phil Tarrant, host of the Smart Property Investment Show. I'm with Grace Ormsby, editor at Momentum Media. My colleague, we work together in shaping the content, the direction, what you hear and read and watch in property investment in Australia, and also the business of real estate, the great brand of real estate business for those real estate agents that tune into us. That's what we do. A roller coaster in property cycles. Grace, here's the headlines. We'll go through it, and then there's
some trends and predictions.
There's five. Everyone likes a list. There's 5 trends. So just summarise here. It tells us, so this is the executive summary. So I've done all the hard work for you. Well, not really. I'm just going to read it from the press release. Domain's done all the hard work for you. I'll tell you what they are. Write them down. Australia's property market, Grace, saw highs and lows with property prices at a record early in the year, then quickly turning to the fastest quarterly decline. Yeah, we know that. That's great. Thanks. Set the scene. The unit market showed resilience in smaller capitals, with prices in Brisbane, Adelaide and Canberra reaching new peaks. Okay. Across the combined capitals, unit prices also held firmer than houses, which is interesting because units have been a bit on the nose comparatively to land, sort of freestanding dwellings over that. They didn't get the hikes. As
we
residential
did
property.
see, what do they call it, like a bigger valley appearing between what house prices were doing and what unit prices were doing. And they always say that, when that does start to occur, you do start seeing more traction in the unit market. And I think we're still with that lag. following on from house prices becoming so affordable and so unaffordable in so many regions for so many people. We saw a lot of people flocking back to unit markets, and I think that's really helped that the second half of the year, really.
Yeah, and I know a lot of people are buying up units at the moment. It's some good buying.
Especially in the undersupplied markets. And there's so many markets now that are undersupplied. You look at all those regional hubs where there hasn't really been a pipeline before COVID, and then they've all had this surge in population and they're really struggling.
Well, this lends itself to the housing affordability crisis, but also the rental crisis, and a lot of people living in cars and stuff. We've sort of been chatting about it on the show, but stuff. And to be fair, there's a lot of places with a lot of units for sale, right? Where there's just, and you think of some of places like, Alexandria or whatever in Sydney, and there's more apartments than people that want to buy them or live in them. But there's other areas, prestige apartments, some regional areas where there is rare as hen's teeth and they're doing well. It gives us also briefing points here, Grace. The smaller capitals and some regional areas rose to new heights with the number of property sales soaring in these areas above the decade average. Okay, maybe that's a bit of a tree change, sea change type stuff, people getting out of the city and chasing those dreams. 2022 was the third busiest year on record for Australia's auction market, with auction volumes 90% higher than the 5-year average. That sort of lends itself to what Tom Panos is telling me. He reckons he's busy. It's been a busy year for him. Yeah,
and I think it is just that normalisation. While we have seen we did see for a lot of this year supply much, much lower, especially spring selling season didn't really exist for a lot of agents and a lot of people that were buying and selling to it. It was definitely a different period. But I guess, again, the first half of the year really lent itself to propping up those numbers. And really, we're seeing more and more people buy and sell for probably shorter periods of time. They're holding on to property for shorter periods of time than probably ever before. So, it makes just sense mathematically. Not that I'm a maths person, putting that out there.
Another disclaimer.
But, of course, that's what's going to happen, especially when you've got pandemics that influence that.
And this is the last point here, Grace. Sort of lends itself to this concept of the scarcity of property. And keyword searches on Domain showed that lifestyle additions and location were high on the wish list, with pool, waterfront, beach view taking out some of the top spots. So those good areas, those good properties in good areas will continue to be good investments or good places for people to buy and occupy properties. It's the fringe properties which have probably been performing the worst. So those in a super rising rate or a rising price environment, people overlook sometimes the hairs on a property. It might be near some power lines, it might be on a main road. A lot of people forget that. But then when things change, they're the ones that come off the most. And traditionally they will pull down the median values. But in some of those properties with some hairs on it in good suburbs, but not in good locations in that size suburbs, you see some houses bucking the trend and still growing. So this is how it all works. So there's a whole bunch of stuff here. You'll be able to read a little bit more on this on smartpropertyinvestment.com.au. But let's go through a couple, Grace. They've got a table here. We won't go too much in that, but a couple of quotes here around it. And this is from Dr. Nicola Powell, who's Domain's Chief of Research and Economics. She does a fair bit with us, doesn't she?
Yeah, she's
a great commentator.
She's great.
Yeah.
Always love having her on the show.
She's good, and it's sort of pretty learned sentiments here. The past 2 years, she says, have been fascinating to watch in real estate. After soaring price growth in 2021, it was inevitable that we would see an adjustment phase of the property cycle in 2022. Yeah, I get that. This is a reminder that homeowners and prospective buyers need to maintain an overall perspective. History tells us, and this is important, history tells us that in the last 30 years, the duration and the steepness of an upswing are longer and greater than a downturn, supporting the idea that it's not timing the market, it's the time spent in the market that counts. And that's like a mantra that most people sort of hear about in property, right?
And you'd hope so. I mean, a lot of people, you wouldn't want to be in property for the short game, really.
No, a lot of people blow their dough.
But even looking at some of these stats from not only the combined capitals, but then across the capital cities, and seeing the amount of price gains that have been achieved basically since March 2020, since the onset of COVID-19, when it really came into the lexicon and we all suddenly had to mask up and couldn't go anywhere. Sydney, 40% price gains over that period. And then in the recent downturn, we've only lost less than just over 8% to that total value, which means that that upswing is still 28.6%.
But you don't hear people saying that's great. People look at the negative, the 8.3%. Now, the argument being if you owned property before the upswing, you got 40% growth. The bad bit is that it's come back by 8.3%, but you still had 28.6% growth. That's pretty good. The issue is for people who bought at the peak of the market, who are just going to go through this, and it is temporary unless you bought an absolute lemon. It's temporary that what you pay for your property has probably come back a bit. And looking at this here in Sydney, it'll be 8.3%. But to the earlier point, the downturn, the upswing is a lot faster and sharper than the downturn. So if you don't need to sell your properties and you can service the debt, I wouldn't worry too much about it. But that sounds a bit glib. But this, again, is a show for property investors who are supposed to know about these things. It's not for maybe struggling owner-occupiers with mortgages. But you look at some of these numbers, Grace, combined capital 33.6% upswing, downturn 4.9% to an aggregate of 27% growth. And this is from the point pre-pandemic to where we are right now. Combined regionals 32%. It's come back only 1.3 to a 30.3% upswing through the pandemic. Sydney 40%, negative 8.3. We spoke about this 28. Melbourne 24.1% upswing. It's come back by 6%. Aggregate growth 16%. Brizzy 42% upswing has come back 4.3%. That makes sense. And
their downturn has started a lot later than everyone else's. So that might have a little bit more to go in that. But even then, you're still cheering if you bought earlier on. If
you're in the market and, on the Smart Property Investment Show, we'll talk about it. You're in it for a long time. We've got property up in Brizzy. I'm not complaining about 36% growth through the pandemic to where we are today, even though it's come back a bit. Adelaide.
Impressive.
Adelaide, 46.9% growth, 0% downswing, so 46.9% growth. So a lot of people, that's nearly 50% over a few years, and that's bonkers, right?
Insane. I mean, that was one of those markets where people have said, a lot of experts have come out and said that this was, needing to normalise for a pretty long time. It was down for quite a long time. It did need quite a big correction.
A big shift.
And normally you hear about corrections going in the negative territory. So it is quite interesting to see it go the positive way. But yeah, anyone that bought property in Adelaide a little while ago.
Happy days.
Yeah.
I reckon anyone that bought property in Australia a little while ago is happy days.
Yep.
And this is why you've got to put stuff into perspective. Everyone's like down in the dumps and doomsday merchants and doom and gloom about sort of prices going backwards and interest rates going up. Hey, it's been all right. Perth, 23.8%. It's come back 1.5%, according to Domain. Post-pandemic starting to a 21.9% aggregate growth. Canberra, 50.3% upswing. It's come back 6% for 41.2%. Darwin, 41.2% upswing. It's come back 8.1%. It's come back about as much as Sydney. That's high to just south of 30%. Aggregate growth, and Hobart 52.2% has come back 3.3% for 47.2%. So the summary is if you've been in property, you had property pre-pandemic, even though it's come back, you're doing all right.
Do not fret.
Take it easy. Relax, everyone.
Enjoy your summer series. Enjoy your break.
Enjoy your summer series. Go and buy some champagne. To the point, knowing it, they talk about it in this report. The impact in mortgage repayments. So 25 basis points this month. I think that accounts on a $500,000 mortgage, about $75 a month difference. So pre-pandemic with the cumulative increase of 3% in interest rates, right? Most people have had a spike. Banks have passed on 3%. On a $500,000 loan, you're in for another $893 a year. At $750,000, you're in for another $1.3 thousand. You've got $1 million loan. Your repayments are $1,700 more a month. It's monthly, and on $2 million, you're paying another nearly $4,000 a month. So the number gets bigger. But anyway, so there's some good numbers there. Go and check it out. Smart Property Investment. Give some more details and some more commentary there from Nicola over at Domain. And thanks, Domain, for sending this stuff through. But let's chat through some of these 2023 trends to watch. We should just put Smart Property Investment on this and say they're ours, right?
We would never.
People always nick ours.
They do, but no, this is all Domain's work. I mean, I agree with every single point that they've made in this. Otherwise, we wouldn't be sharing it.
Yeah,
really.
No, absolutely. We'll go to another break. Stay with us. Come back. 5 trends to watch in 2023. Back in a moment.
Want to slash thousands off your home loan repayments? Whether you're an investor or homeowner, we know how important it is to find the lender that suits your unique situation and with the best rate. If you've not compared your home or investment loan in the last 12 months, you may be able to cut your repayments today with a different lender. That could mean more money in your bank account and less stress when it comes to paying your loan. Find out why more borrowers are turning to Finny to refinance their home loans. Call us now on 1300 002 023 and find out what you could save, or visit our website finny.com.au to book an appointment.
Welcome back. Phil Tarrant, Grace Ormsby, your team at Smart Property Investment, real estate within Momentum Media. Thanks for tuning in, and thanks also for everyone for their patronage.
Yeah,
listening, tuning into it over 2022. We enjoy doing this. It's one of the highlights of my week. We do a couple of times a week, actually, getting together to record this podcast, and I just sort of get blown away by its ongoing growth. I mentioned beforehand, 240,000 downloads a month this thing's getting now, and I just sit there thinking, Jesus, that's a lot of people listening to me drone on. It's funny where you sort of, people go, oh, do you do that podcast? They sort of overhear at a pub somewhere or something, go, yeah, that's me. Don't ask me about property. I don't know anything. But
I mean, you do.
Oh, I could talk to people about it. But sometimes I get really good advantages, right? Like this really good report here from Domain telling us what's going on. And you know, Domain's data is pretty good. I know some of the execs over there. I had lunch with one of their bright sparks that looks after data only last week, and still a lot of confidence in the mechanism that is property data inside of Australia. They're still working on it. They're still improving it. They're getting faster. It's getting richer, and there's some really smart tech companies out there now.
It's mind-boggling,
doing
to be honest.
some cool stuff.
What's going on?
I sound like I go to lunch all the time. I was chatting with, I'm sure he'd be happy. He's David Choi. He's doing some smart stuff. He sort of does a lot of investments inside of tech. And just what they can do with data these days is mind-blowing. But anyway, trends to watch. Number one, Grace, downturns will be shorter and less severe. Okay.
It's a timely time for them to be talking about this, because obviously we are in the midst of a downturn right now, as we've mentioned before the break when we were talking about the percentages, I guess, in the capital gains that have been lost really over the last 6 months. But I think when we used to view property cycles as taking 7 to 10 years, now we're sort of looking at, I don't want to put a real figure on it, but, 3 to 5 years of upward swings, and then probably 12 to 24 months of a downturn. And that's not bad.
It's not bad. And there are some numbers around. I can't remember exactly what they are, of like how long it takes from the bottom. And you don't know you're at the bottom of the downturn until you move on.
Hindsight is a very helpful indicator, isn't it?
Yeah, but I don't think there's any market that, Perth is probably an exception. It's got hammered last decade, but it makes back any losses in a downturn sort of 3 years. So anyway, and that's what history tells us. And as a student in history, I tend to agree with that. And even though you might be sitting there thinking right now it's gone back 8.3% in Sydney, sort of read your history. It'll come back, despite some of the very sort of strange projections you get from people around Australian real estate. But downturns will be shorter and less severe. I concur with this. And Domain writes, as we move into 2023, Domain's report reminds buyers and sellers of the cyclical nature of the property market, and that property should be viewed as a long-term investment. This is his timing the market versus time in the market stuff. With interest rates rising and property prices falling, it can understandably make homeowners feel uncertain about their property journey. However, while property prices will continue to soften in 2023, it is unlikely they will erase all the growth seen during the pandemic boom. So either how far it comes back, it's not going to erode where it was at the start of the pandemic. That's all pretty sort of straightforward. Yeah, most people give a tick against that. No worries. Trend number 2, Grace, multi-speed property markets will create opportunities for upgraders. Yeah, and this is going to be across both locations and asset classes, I would say. Domain expects, the report says here, Domain expects that the multi-speed market will become more apparent in 2023, with some areas falling faster while others will be more resilient. resilient being holding their prices better, I imagine. Overall, entry price houses and units will hold firmer. Okay, this is asset selection, particularly in the most expensive capital cities, Sydney and Melbourne. Yeah, that's a demand thing. This will be driven by the affordability barriers of purchasing, first-home incentives and deteriorating borrow capacity, steering demand to more affordable options. Yep, people can't buy as fancy a place as what they used to because they can't borrow as much money. Simple economics. This, coupled with houses at a premium price point seeing greater falls, will create opportunities for upgraders.
It makes complete sense. And to be honest with you, Phil, I feel like we're already seeing this across Sydney. A lot of those entry-level units and even some of the houses in those entry-level markets, no one that has bought previously in those markets is going to want to lose money on what they paid. And while we have seen gains, I would say a lot of those have been focused more on the prestige end of the market, whereas we haven't seen as dramatic a rise in property prices across some of those other markets. So with the middle ring and the outer ring, I do think it's already here that's a thing. And, that's normally what happens anyway throughout any property cycle. So it's no surprise that it will happen again in 2023.
Absolutely. And to get some sense that the key sort of theme for this chat, breaking this report down, is the continuity of property in Australia. And it's talking about how, yes, property prices are slumping or softening, however, they will return and grow. And history tells us that. But the hot tip is that property investors, and this report's probably more owner-occupiers, it's pulling the heartstrings of people who want a house to put a family and upgrade and all that sort of stuff. So it's different, but sort of the same. But the hot tip is if you're investing in property in Australia, you've got two really, really big, strong and powerful partners. Number one is the bank, who give you the capacity of leverage. And banks, let me tell you, banks don't want you to lose your home. They want you paying your mortgage back with interest. And the other key partner is the Australian government and state-based governments. To this point here, providing incentives to make housing affordability and accessibility more open to first-home buyers. There's lots of benefits there. There's still some issues around building approvals and whether or not they can get new first-home owners into houses. But the government structurally likes property investors to provide housing for tenants. That's how it's fundamentally structured. And there is incentives for property investors to provide the housing by way of negative gearing and other tax breaks like capital gains stuff. So they're two big, powerful partners, which gives Aussies a lot of confidence in their ability as investors to, irrespective of market conditions, with the right smarts, the right strategy, the right diligence and appropriate financial discipline, it can be a good asset class. It's sort of connected with point number 3 here, Grace. Interest rates aren't the only factor affecting house prices. Yep.
You would hope not.
You would hope not. A lot of people who don't know the Australian market thinks there'll be bloodbaths when rates start going up. And to be fair, the official cash rate now is still below sort of long-term average, right? Like, it's gone up 8 times since it sort of kicked off just before the federal election. It's at its highest level in 10 years. So a big minority of Australian investors, this is the highest interest rate they've ever had. And you've gone from emergency settings at 3.1% to where it is today, right? Like, guess what? It's normal. So the Australian housing market will see some immediate impacts from rising rates. But what will happen, and this is my trend for 2023, is that there will be a confidence mindset shift with Australian investors. I'm not talking about owner-occupiers when we get to the top of that rate rising cycle, and that's when you're going to see some another sort of surge in property kicking the gear, and the immediate thing will be an uplift of those prices back to where they were.
That's that floor, isn't it? That's that floor that will never go away from the market. It's just very much determined by that confidence factor.
It's all about confidence, and if people feel confident in their ability to generate income and pay the bills, there's more confidence. And I reckon, Grace, there's a lot more hurt in the market at the moment than what is being led on by the numbers. There is a lag, hence the reason why we've got 2 months now until the Reserve Bank meets in February for a lot of these numbers to come through. And I reckon a lot of Aussies are going, I'll just get through Christmas and then I'll tighten up the belt, then I'll do some budgeting, I'll stop spending. And so I think that will be that reversal of those inflationary pressures, and you'll start seeing that come back down where the RBA is trying to target it, that target band of 2-3%. That's probably already happened in the background. No one's talking about it. The numbers will show it eventually. But this point here, point 3, is interest rates aren't the only factor affecting housing prices, it says, Grace, the speed and scale that prices soften will depend on many factors. However, the depth of the downturn will largely be shaped by how high interest rates go and when and how quickly inflation eases. That's pretty much what I just said.
It's also, Phil, just to jump in there, it's so much a psychological thing at this point, I think, too. And that is really hard to put down in data. But you think about how crappy the last couple of years have been for a lot of people. And this is the first Christmas that probably has felt quite normal. So I don't think anyone's really willing to give that away. You know, they're happy to deal with that at the moment and just know that, you know, after Christmas, things will have to change.
Things will have to change. And you know, because of COVID, family balance sheet savings are the strongest they've ever been. So, but that'll start getting eroded. You know, if you've got a $2 million mortgage, what did we say it was? $3,000-4,000 more a month in repayments. Like, you know, that's a lot of money to find sort of behind the couch or in the ashtray of your car. But it continues here. But interest rates are not the only factor in our prices. Tax settings, sort of spoke about it. Banking regulation, population, income growth. I think you'll see as we get to the top of the interest rate cycle, serviceability requirements coming from APRA, who's the prudential regulator at the moment. They've got a 3% buffer on serviceability. That might, when they want to start shifting stuff into gears, they might bring that back a bit. Who knows? That's the sort of regulatory tightening that can happen, and also loosening depending on market cycles. Population, it says here, Grace, and income growth and the responsiveness of new housing supply to growing demand will all make an impact. Dr. Powell comments, initially, rate hikes were a huge shock to potential buyers in 22, but now buyers have adjusted to this new norm. This is what we're chatting about, the mindset stuff. She continues, and are more mindful of their lower borrowing capacity. With the wave of fixed rate expiring in 2023, we'll start to see true impact of interest rate rises on consumer spending as more Australians tighten their belt to cover step-up repayments. It's what we sort of spoke about. So a big issue here, that big elephant in the room are these tranches of fixed rates coming off to variable, and that will be the double whammy of higher rates, but then also exacerbated by having to pay variable interest rates. So what you may see is a big spate of refinancing, because there'll probably be some fat you can shave in terms of your interest rates when you come off fixed and go to variable. If you're doing that, make sure you get on top of it at least 2 to 3 months before to sort your stuff out, because you should be able to either negotiate with the bank that you're with or look to refinance to get that reset at a variable rate if you want to go variable with discounts and everything depending on your borrowing circumstances to get the rate you want, or you might want to fix again. But you're going to be rolling a dice on that, Grace, if that's the way you want to go. So, yeah, we agree with all that. Point 4, the return of international immigration will increase housing demand. Yeah, this is a big issue. Good if you're a property investor, because it's going to put upwards pressure on property initially through rent. And one of the great things of the Great Australian Dream, Grace, is that migrants normally kick off as renters and they work bloody hard. It's the migrant story that is Australia. And they're great buyers of real estate, migrants. They absolutely appreciate and love the opportunity Australia provides them, and it's great to accelerate them into home ownership. So this is all good if you have property. This is probably not so good if you're looking for a place to rent. And for those people, when this actually starts happening, there will be a shift to demand on purchasing, which will lift up values. But Domain says here, with the opening of the international borders in early 2022, the country's major capitals welcome back many skilled immigrants and overseas students. As part of the budget, the Australian government has increased the quota of this is the permanent migration program to address the skills gap, essentially be the biggest immigration drive ever for Australia. We need it. You
think about the fact that we went, to minus? Weren't we in negative territory for a little while?
Close, yeah. And we weren't making enough babies, even though people were locked up in COVID. But I'm happy to report I did my part during that, so we added to the population. This influx, Grace, of people arriving from overseas will add incredible demand to Australia's housing market. Initially, will place further strain on rental market. Okay, good, I've telegraphed that. But continued rising rents will also make purchasing more attractive for strategic investors. Okay, that's good. Last point here, Grace. Buyers will be willing to pay for the right neighbourhood. We sort of touched on this beforehand. In 2020, Domain's analysis of keyword searches showed lifestyle benefits and location were high on wish lists such as pool, waterfront, beach and view. It's anticipated this will continue as many buyers still willing to pay a price premium for the right neighbourhood and their home's livability features. I think I won't go to Dr. Powell's comments there, but I think, and this is a key mindset shift for a lot of Australians in how they choose to live, tenants, but also owner-occupier. So with a lens of property investment, the livability of the home, the livability of the apartment, the livability of the area has been compressed. I think 10 years of change has been compressed into 2, whereas people now aren't as forgiving of bad places to live.
Yeah.
So you need to make sure your investments are attractive through the purpose of livability. And that's location, what it looks like, amenities, all that sort of stuff.
I always think back to a quote from Bernard Salt. He spoke at one of our events earlier this year, and he was saying that now more than ever, people are willing to spend more of their income on getting what they need from their home because they spend so much more time there. You know, you want it to have an office, you want it to have outdoor areas for entertaining because you want to be entertaining rather than necessarily going out for dinner all the time. And it's still, well, it's even more so a status symbol than ever before. And that comes back, I think, to all those lifestyle elements rather than just how big it is. You need usable space. You need 3 living zones so you can have the kids in one end, you know, maybe even the grandparents for when they come for their 3-month sojourn over the Christmas period. But it's all those things that have become more important than ever. And you're seeing that with rentals, I think, as well. Like the addition of a study helps so much in the rental game.
Yeah, and I'm sort of quite familiar with, I haven't seen him speak for quite some time, Bernard Salt, but he's got a really good way of highlighting the changing way in which Australians have lived and, you know, through pre-war periods and a baby booming period, cool. You know, how houses have changed, you know, how people have lived, by memory, how a lot of the Mediterranean migrant communities brought this idea of alfresco dining. It's very much, you know, that's now part of the Australian way of living, but a lot of it comes through our Mediterranean migrant communities who come in where we started doing more alfresco stuff and it changed the way houses were. So
even the fact that now you want to walk through the whole house to see, you know, the pillows and cushions on display on all the beds past every bedroom that you're walking past, whereas the living area used to be the only place you'd entertain.
You do that, yeah.
And that would be at the front of the house. You didn't let anyone through to the back. Like, it's just wild how different things are.
It is, you know, it is a status symbol property, but for investors, you got to make sure if you've got young professionals, for example, renting your place or a young family, like, you know, more people working from home. And I think that's here to stay. You're seeing a shift. I think people are now starting to realise that, it's actually okay to go to the office a bit because it's good for you. But, you know, the way the utility of where we live has changed rapidly and property investors need to be conscious of that. But that also extrapolates out if people are working more from home, therefore the home itself needs to be better geared to be supportive of it, and you'll be able to get rental premiums as a result of that. But it's got to be in a place now where you have satellite infrastructure. So you need to be able to essentially, my view, you've got to be able to walk to a coffee shop, a pub, some sort of food joint to get some tucker, you know, a supermarket. Like that's got to be walking distance now. So you're seeing the changing nature of neighbourhoods now. You know, these suburban shops are starting to bounce back because people want to be in close proximity to them. But anyway, I reckon we've done pretty well there, Grace. We've spoken for 40 minutes when it should have only been about 20.
Summer series, you don't know what you're going to get.
You never know what you're going to get. It's like a bad sunburn. You spend too long in the sun, you get burned, much like property.
We might need to get some aloe for the next one then.
The property aloe vera. There you go. Do you use the word sojourn?
Oh, I don't like saying it because it does sound it doesn't roll off the tongue very well.
That's another word I struggle with. What was the cumulative? There you go.
Cumulative.
It's good. Thanks, Grace. Thanks for coming in.
Thanks, Phil.
Spending your summer to come and have a yarn with me on the Smart Property Investment Show. I hope you enjoyed that, everyone. Hey, we're producing podcasts like any given time. While Australia goes on holidays and relaxes, we keep our nose to the millstone. I think I got the right grindstone, millstone. I think it's a millstone. I love the mixed metaphor. Keeping at it because I know during this period of time, Grace, is when we probably get most of our traffic.
Prime podcast listening
People love
time.
it. They love it. This is what we do. That's Grace Ormsby, editor of real estate here at Momentum. I'm Phil Tarrant, your host of the Smart Property Investment Show. Hope you enjoy that. Remember to check out smartpropertyinvestment.com.au. Heaps of stuff there. You can while away your your evenings in front of the television with multiple devices looking up property prices. That's what I'd be doing. Social media, Smart Property HQ. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
HR Leader is your source of news, insights, and more for HR, leaders, and people managers. Subscribe today at hrleader.com.au.